My name is Stewart Hennefer. I'm a real estate agent here in Salt Lake City, Utah for Utah Real Estate. Been a real estate agent here in the market for just over 20 years. And as you're seeing in the market here in 2022, there's some interesting things going on with the market, interest rates. And I want to sit down here with my mortgage guy, Blake Reese, which has been my mortgage guy for nearly 15 years. And he's my go-to when I need any mortgage help. So I got an email from Blake the other day that stemmed this conversation of a lot of different programs that are going on. And in my 20 years of being in real estate, my job is homes, and I really haven't paid attention to all the programs. But with things changing in the market, I think I'm finding out that it's more important for me to know what's going on. Of course, I can't follow it all day, every day, because it's so intricate. There's so many changes, programs, you name it. And so anyway, we'll get to that. I want to introduce Blake Reese. This is Blake, and I'll let him tell you a little bit about him, and we'll go forward.
Yeah, so I'm Blake Reese. My team is with Cross Country Mortgage, and we've been in the business around for almost 30 years now. And we've helped thousands of homeowners get into their first homes. We've been in the top 1% in originators in America for many years running now, and have hundreds of 5-star reviews out there. Not pat ourselves on the back too hard, but we know what we're doing. Our branding statement as a team is when you need a miracle, turning complex into approved. And I feel like we've worked really hard to kind of position ourselves in the marketplace to do exactly that.
Wonderful, wonderful. So in my 20 years of real estate, I haven't followed these programs. My job was to in general, is to find a need and fill it. So anybody that comes to me that has a need in real estate, my job is to fill the need that they have. And in following mortgage programs over the years, I haven't done that. I've just turned to Blake and said, talk to Blake. He knows the ins, the outs. He studies the market, what's going on with all these different programs. And it would make my head explode if I had to follow that all day amongst everything else that I do as a real estate agent. So I wanted to, first of all, before we get into some of these programs, Blake, tell me a little bit about what you've seen that maybe you've said this word several times, unprecedented in what we're seeing. So tell me kind of what you've seen and where we've come and what brings us here.
Well, let me preface by saying that things change so much, so often, and we are always, of course, do our best to stay on top of everything. But I think it's important to kind of notate that we're fallible too. We're human beings. We're drinking through a fire hose right now of all the information coming to us, but just to be aware that we do our very best to have timely, accurate information, but we don't know everything. We're human beings, and so don't bet the family farm on some of our advice we give, but and also I think it's also important to seek out licensed professionals. If you have any questions about things that you're working on in your life or in business transactions, of course you're licensed as a real estate agent. If you have questions, there's licensed financial advisors and accountants and others that can help with that.
So kind of we stay in our lane.
Yeah.
I'm a real estate agent. He's a
exactly.
mortgage guy. I'm not an attorney. I'm not a pilot.
Right.
I'm not a surgeon. So regardless of what hotel I stayed at last night, I'm still a real estate agent. So let's jump into this email real quick, Blake. And so, as I think mortgage banks and brokers and just some whole mortgage industry, they start coming out with new programs to stimulate the market, to help out with whatever the things, within the things that they can control. Obviously they can't control what are going on with interest rates and what the feds do, but they certainly scramble to find the best things. So just a couple of these. So we got loans up to $5 million, including cash out refinances.
Yeah, so let's take a quick step back and kind of answer your first question about unprecedented times. So I think the times we find ourselves in right now are truly unprecedented. I haven't seen anything like what we've seen in the last couple of years since, honestly, like around 2008, 2009-ish, and then before that, never. It's been a crazy market right now. What we've seen, as you know, we all know, I think even the general public, we've seen a lot of the last couple of years, this red hot market not only in Utah, but across the country, We've seen unprecedented times when it comes to making offers, multiple offers. We had a new term that sprang to life recently, the appraisal gap,
Right.
which we found out was how much someone was willing to pay over the purchase price of a house. And then then recently, the last couple of months, we've seen the Fed pouring cold water on the economy by virtue of their little hikes that they've been doing, the Fed rate hikes, and that really has affected every other part of what we do, and has sent our interest rates, as everyone knows, if you turn on the TV, look at the billboards on I-15, sent our rates into kind of a space that we've never seen before. It's when we say unprecedented, there's been so much irregularity in our rates and volatility on a daily basis. Last Thursday we saw 184 basis point change in our rates. I've never seen that before. And what that equates to is like almost 1 full percent in layman's terms. When we see if we're at 6%, we're going almost to 7% in a singular day, and then the next day it comes back by 84 basis points, and then it's been a volatile time for all of us. So and I think that's is what's driven a lot of consumer fear right now. So, there's a lot of our clients are like, okay, do I buy now? Do I buy later? What's going on with interest rates? What should I do? And so I think these programs really kind of go to the heart of, well, actually, let me step back and say, I watched a Dave Ramsey a YouTube special recently where he thinks right now is the best time to buy a house.
I saw that, yeah.
For a lot of different reasons. And I think it is too. I think what we've seen, maybe 6 months ago, not so much, or a year ago, because we had, all-time price, we had really a space where the sellers were controlling every part of that transaction.
Certainly.
Now that faucet is kind of turned off, at least that's what I've seen. I'll want to hear a little bit more about what you have seen in the marketplace about that. But from our perspective, we've seen that shut down, where now buyers are a lot more in control. We've seen prices stabilize, at least. We've seen listings go for what they should be listing at. Appraisal gaps have gone away. So we've seen a lot of things, I think, that are really beneficial for our buyers.
Certainly.
And when it comes to rates, I think the biggest issue is trying to understand there's an old axiom: you marry the house, you date the rates, meaning that rates come and go. And you buy the house, and then next year, theoretically, in the future, you would be able to refinance. And there was a piece of good news that I saw this morning about that very thing, where Fannie Mae came out and basically said that their opinion is rates are going to go to 4.5 next year. So that bodes well for buying houses during that, in a space where, and by the way, once that happens, I think, Stu, what you're going to see is a lot more people jump into the market. A lot more buyers jumping in when those rates go down. That's why another reason I think now is a perfect time.
I agree. What I've seen with it, over the last couple of years, we've seen, like Blake mentioned, this appraisal gap. Something I never even heard that term in 20 years till this. And then as the market starts to soften or I say correct a little bit, they're like, "Oh, the price is going down." Well, that appraisal gap used to be about 10%. What I found. So if you're putting an offer on a house at $500,000, that's going to appraise for $500,000, the appraisal gap is you're actually offering $550 for that home, expecting it to appraise for $500, and you're coming up with that additional $50,000 in cash. Okay, because the lender's only lending up to the appraised value. So we saw this appraisal gap show up automatically, and that just instantly put a 10% increase in values of the market. Well, purchase prices of market. But as soon as the market started to shift a little bit, that disappeared overnight. And so did prices come down? Did the market come down? No, the market was always here. People were just paying above the market for that. So that appraisal gap disappeared overnight. And what we've seen as a shift, sellers were not, even allow for time for appraisals or financing or inspections or making the earnest money hard, non-refundable up front. That all went away overnight. So all good news, especially for buyers, because
Yes.
Buyers need to do their inspections. They need to have a contract that has contingencies in it. And that's a conversation for another day.
But I think it speaks volumes to the fact that right now is a good time.
Absolutely, absolutely. You know, I track inventory numbers, and in the spring of 2021, right, pandemic going on, we had about 350 homes on the market in Salt Lake County. That's condos to $1 million homes. And a year later, we were about 350. Right before the interest rate started going up in maybe April, we were about 550 in Salt Lake County. Every month passed from May, June, July, August, it went up another 500 homes per month. So a normal market in Salt Lake County is about 4,000 to 4,500 homes on the market. So to put it in perspective, right now, this morning we were at 2,555. So right around 2,500 homes. That's far from normal. I did also search East Side, Salt Lake City. That number was significantly lower. So while we think there's a lot of homes on the market, they're really not, and they're going to be gobbled up fast. So now's the time to hit the market. I think the interest rate is a temporary, like Blake says. I love that. You marry the house, you date the interest rate, because the interest rate's going to be out the door at some point. You know, I think it has to come back. I don't want to make any predictions, but
yeah, we hope
based on experience, yeah, we'll see.
Well, and there's a lot of experts out there saying that it will.
Yeah.
So, I mean, from the bigger brokerages, you know, Wells Fargo and Fannie Mae is the preeminent voice on that. So, if Fannie Mae is saying it's coming back,
when they speak,
that's we
when
we
my
listen.
dad spoke when I was a kid, I listened. When Fannie Mae speaks, we listen.
We listen.
Okay.
Yeah.
So I think that some really interesting things are happening in the market. Inventory's coming up a little bit. It's still not great. I've got some ideas on where that inventory is and who controls that for a later day. But the market is what it is now, and I think with these new programs coming out, we just want to review some of these with Blake and go through a few of them, so you can be aware of. I mean, I certainly want to know this for working with my clients moving forward, because my client may have a need that they don't know they need that we need to fill. As I contact my people and be in touch with them, these are some of the conversations that I'll have. So without further ado, want to run into this?
Well, yeah. Well, let me mention one thing first. I think it's important to, and both of us have seen this, to know that we've seen a lot of people sitting on the sidelines for a long time. And, well, some people in certain cases where they felt like maybe they didn't qualify. So
yeah, they were locked out of
the market.
Qualified. They had their down payment. They saved their money.
Exactly.
Had their credit. Their credit was qualified enough, and they're ready. They were ace straights and flushes. But what they didn't count on is that appraisal gap, that extra $50,000 in cash that they had to come up with somewhere, and that just wasn't available.
Or cash investors coming in and taking bids with cash offers.
True.
So I think there's been a lot of maybe concern, and that's about what's going to happen with house prices, etc. So a lot of people have kind of at some point just gave up. A lot of our clients did. We have a bucket actually for all the people that have kind of said, look, let's just wait, let's hold on to see what happens. And I think now that's kind of sorting itself out. So let's talk about these. And by the way, these programs are for those people. When we talk about a lot of the people that have sat on the sidelines, in many cases, there's been one or two things holding them back from feeling like they qualified. It could be a matter of taxes, which we'll talk about today. It could be a matter of W-2. Could be a matter of immigration status, where maybe there's just an ITIN number or they've got a work permit.
Sure.
There are ways to handle those and to create a program. So I think right now, one of the main reasons I wanted to get together with you is to talk about all these creative spaces where the people that have been waiting, I believe it's a great time, and the programs have come together to make it a great time.
Awesome. So I'm just going to rattle through some of these and just kind of list them first, and then we'll go through them one at a time. So we've got loans up to $5 million, including cash out refinances. We got cash can be used for asset depletion. That'll be a very interesting one. 1 year self-employed and 1 year tax return program. Priced as a full doc. We'll get to that. In-depth tax return review. If as a one-time expense, Section 179 deduction. This is all stuff I don't even know what I'm talking about here, and this is what we'll go through.
Yeah.
No credit, expat, work visa, other work authorization programs. Then unique collateral types, including non-worldable condos, co-ops, condo hotels, mixed use, acreage, hobby farms. A couple more things.
Let's start with those.
Okay.
Yeah,
we'll move
let's start
to
with those. I don't want to get too deep. So,
well, let me just rattle these off because
Okay.
everyone know we're going to be hitting. We're going
Okay.
to talk about a DSCR. I've been in business 20 years. Don't even know what that is, or I don't know if I should, but it's a good thing Blake does. Asset depletion qualifier, bank statement, doctor loans, foreign national, jumbos, fix and flips, 1 year tax return, unique collateral types. So that's all the stuff we're going to be covering. So
Yeah.
we'll start there, Blake.
yeah, jump in. Well, so as I said, I think there are so many people that have sat on the sidelines for such a long time, and I know we've got so many clients. I know over the years, you and I have had many clients together that have had concerns about whether or not they were able to qualify.
Right.
Qualification for mortgage purposes, really, if we boil it down, is based on three things. You've got your ability to do a down payment, your asset, your credit report, what your credit scores are, and your income. So that third one, the income, has been the one that really holds a lot of people up. We've talked to hundreds of self-employed people over the years that have come to us and said, look, I'd love to get a house, but I can't. My tax returns, I write everything off on my tax returns. I'm on 1099 for 1 year. I've had multiple job changes. I've had a job gap. Especially what we've seen with when we went through the pandemic. A lot of people changing jobs, moving around, getting laid off, waiting for a time going back into the workforce. A lot of these programs are geared towards helping those people out. So I'll jump in and kind of just give you a brief overview of the first ones that we went through. One of the things that I've seen so much of in the past, Fannie Mae has been, and Freddie Mac, and all of the entities for that matter. You have the those are quasi-governmental agencies, and then you have FHA and USDA, rural housing, and VA, which are mostly wholly government entities that kind of regulate what they allow and what they don't. What we've seen is after 2008 was a snapback on the excesses that we kind of saw back in those days, the stated income loans and the other programs that most people feel like moved us into the Great Recession, or some people call it a depression. But what we've seen is them snapping back on that and really coming to a place where you had to be inside the box. And that was that way for a number of years. And I think the good news is that there are a number of what we call non-QM programs out there now, or quality mortgages, it's in layman's terms, which allows us to get more creative. And we need that right now. All the people that have sat on the sidelines. So let's talk about taxes real quick. So traditionally, the main investors have wanted to see 2 years of tax returns, almost always. And they do have done a very brutal underwriting, overwriting. It's called a self-employed tax analysis. It's been pretty brutal, and they have not allowed us to take any quarter inside there. In essence, if they have their gross income, they have their write-offs, and then they have their net income. And in the past, that net income is what we've had to use, and we know now so many people have write-offs inside their companies. For expenses and good CPAs sometimes that help them out to get to the lowest theoretically allowable tax number that they could get to, and we all understand that. I mean that's what CPAs are there for, is to follow the rules and get you the best number they can. But that's on our side of the coin, that's hurt us, and so at least it's hurt our ability to qualify in the past. So these programs will kind of start 1 year of tax returns. I love this program because in the past they've been so stringent on that 2 years, and there's a lot of people now that just need a 1 year tax return. So we're going to analyze just 1 year, most recent year of tax returns. And by the way, we're going to price that out as a standard investor product interest rate. So instead of being the non-QMs, as we kind of like the creative programs of a little bit higher interest rate. And by the way, those have come a long way too. What I've seen recently is maybe a 1% interest rate differential in our conforming stuff versus our non-conforming. It's not bad. So kind of good to know that. But the 1 year tax returns has really helped a lot of people who have had to make job changes, shifts, etc. And there are several investors out there that are allowing for 1 year of tax returns, including Freddie Mac, although they have a caveat that they had to have owned their house or their business for at least 5 years. Okay. But the new program that does not have that requirement, so it's just 1 year.
Cool.
What was the next thing?
I'll just put those in front of you.
Sure. Okay. So I think one of the important parts is the in-depth tax return review and one-time expense section 179 deduction. What we've seen a lot of when I've done thousands of self-employed tax analysis, what I see a lot is our company owners taking deductions for singular events. So it may be that their shop burnt down; they had to redo their whole entire shop. It may
whole fleet of cars.
Whole fleet of cars. Something happened.
Big expense.
Some big expense that happened on a one-time event. And what's happened in the past is they forced us to use that against them. And now what we're seeing is us being able to go in and deduct that expense out as a one-time expense. So in essence, it's not going to affect their income in the year that we do the analysis.
Oh, cool.
Yeah, and also loss carryovers. We have a lot of people who do passive loss carryovers from years previous, meaning they had a loss in years past, and then the rules of accounting allow them to pass that loss forward through the future years. What we know, you and I both know, that's not affecting their current income or their current ability to qualify for a house.
Right.
It just means that they had a loss back then, so we're able to back that out as well now.
Oh, nice.
Yeah.
Awesome.
Yeah. Loans up to $5 million, before just before pandemic, a lot of our jumbo loans either curtailed their ability to do something entirely or they went out of business. So jumbo loans are back. And jumbo loans are notoriously strict in their underwriting guidelines. Right. We've got a number of programs now that have come back in with non-QM and private investors. And when I say private, even credit unions. We've got credit unions that control their own portfolio, so they get to make the decisions on what they'll allow. Right. So we have the ability to actually broker to those credit unions and use their programs as a part of what we do collectively.
Oh, nice.
Yeah. So the jumbo loans, I mean, it's, in a nutshell, they've gotten much more flexible. We can go down to 620 on a credit score. It used to be they had to have a minimum 700. Usually debt ratios are just mandatorily at 43%, and a lot of these have allowed us to go to 50%.
What is that loan limit right now?
Which loan limit?
The jumbo, when you go from regular conventional to jumbo.
Good question. So it's one of the many things we have to kind of keep track of in our business. It gets a little pandemonium sometimes, but every beginning of each year, Fannie, Freddie, FHA all come out with what they call their new loan limitations. Right. And one of the cool things about that is that at times they allow us to go back in. Like now, it's October, which is $647,000. That's our maximum loan limitation for a conforming loan amount right now.
In Salt Lake County.
In Salt Lake County.
And it changes. It's different for counties.
Different for counties. Changes different for states. Changes every year. Recently, what they've done is come back in and said in January we're going to up that amount to $715,000. One of the cool parts of our relationships with our investors is sometimes they allow us to get started a little early, which we've already done, and so that $715,000, it's called the early bird special. We've put that into place right now, and in fact, we've got several transactions that we're working on right now that we're moving that loan amount up to the $715 because we want to stay under conforming guidelines. We don't want to get into the jumbos, which sometimes get a little bit more sticky.
Right. Okay.
Yeah.
Awesome.
Yeah. Let's go through these. I think
Yeah.
let's just go one by one. Tick it off, and
I'll just put that in front.
All right. So the first one is DSCR. We talked a little bit about this earlier. A lot of people. So let's move to the number 3 thing was income, types of income. So in kind of response to what happened in 2008 and 9, there was an act, the Dodd-Frank Act, came out and said, look, no more of this no income stuff. We have to make sure we don't want to take mom and dad's house from them. Right. They've been working hard for that, and they've acquired this equity, and we're going to make sure that the loans we're giving on these houses have the ability, what they called ATR, or ability to repay. So what in essence happened, which is good, it brought the industry back into a space where we had to prove this person has the ability to repay this loan, which is good. I think it's good for our industry. I think what we had before clearly didn't work, as evidence.
Sure was nice though.
Yeah, it was fun. It lasted, but the aftermath was not. The hangover was ugly on that one. Yeah. So, but what we've done now is started to understand a little bit. Many investors have started to understand that, look, one size does not fit all.
Right.
And, maybe we need to kind of step back just a little bit and start to give a little bit more credibility to those differing income types so that we still have the ability to repay, but it's a different type of income sometimes. Mm-hmm. So, case in point, DSCR stands for debt service coverage ratio. When you have an investor buying a house, the investor is going to look at the potential income, income when they're buying that house, so that they understand that we have a debt that's being created, a mortgage, but we also understand that they've got rents coming in.
Certainly.
Yeah. So the rents are going to offset, it's an income source that's going to offset the debt and create the ability to repay ATR for that program.
Okay.
And so investors are offering that program. So let's start with DSCR. Your question earlier stands for debt service coverage ratio. So investors understood at a point that we need to provide ability to repay, but we also need to have a space of flexibility because we understand that not everybody fits one size.
Sure.
So debt service coverage ratio allows for an investor who wants to buy a property to come in and see that we know the property is going to create income, rental income.
Right.
We also know a mortgage will be established on that property so that the income would offset the debt.
Okay.
And we understand that there's enough money coming in from the income to offset the debt. So the creative part of that is that at that point, we don't need to see any tax returns. We don't need to see any W-2s, pay stubs, W-2s, verifications of employment. We don't care about any of that stuff.
Right.
Because we know the property is going to create enough income.
Okay.
So to me, that's a powerful tool for investors. So the reality there is, as long as you have enough money for the down payment, which could be as low as 15%,
right,
with mortgage insurance, caveat, we like 20-25%, or in this market, depending on prices, sometimes 30%, depending on how much you have to put down to make it more and more comfortable to meet that debt service coverage ratio.
Okay.
So one of the other new programs is called asset depletion. And there are variations of asset depletion, but the premise is this. You have people that, for one reason or another, have developed a large asset. Whether it's maybe through inheritance, maybe it's through saving many years in a 401k, maybe they won the lottery, who knows?
Right.
Don't have a job, right?
Certainly.
You've got an asset, don't have a job.
Right.
We know, you and I, as just laymen, would know, look, well, I don't have a job, but I've got $500,000 sitting here in a savings account. Certainly I can use that money to pay on a monthly basis for a mortgage.
Right.
And so investors realized the same thing and said, look, there are a number of ways that we can use to convert this asset into income.
Okay.
Fannie Mae, Freddie Mac allow for the establishment of a trust. So the trust would create monthly income, which flow to them on a monthly basis. There are other programs that just look at the asset and go, man, that's enough. Right. they amortize it over a few years and go, yeah, that's enough money. We understand that you can pay the mortgage with that asset.
Right.
And so there are, like I said, number of variations on how investors look at it, but the reality of that is we're just taking an asset and creating income out of it.
Nice.
Yeah.
Nice.
Yeah. So, and once again, I think these programs are long overdue. We want programs to make sense because we don't want to repeat of what happened before, but we also want to have some flexibility so that Americans are able to buy homes that they want to.
Awesome.
Next is, I think one of our most popular is what's called bank statement.
Okay.
So there are a lot of people out there that, for whatever reason, maybe they own a company and they have money flowing through their company, but the company shows a loss. But their income flows directly through to their bank statement.
Right.
So they've got that income. Or we've seen other situations where for whatever reason we don't have a W-2 or a pay stub.
Okay.
But we do have money flowing through either to a personal bank account or to a business bank account.
Okay.
Investors looked at that and said, this is ability to repay. We have money flowing through, we can prove the money flowing through. So they've set up several different varieties of this, but in essence, either a 12-month or a 24-month program. We like to kind of start at 12 months because it makes it more simple. We can take either personal or business, if we take business returns, there's a certain percentage they take out for expenses.
Okay.
But even that, they do make sense. For
Right.
example, if you are maybe like a hairstylist, we understand that you're not going to have a lot of expense and overhead other than just your rents, your booth rent. So we know that we're going to take out, we're going to subtract less from that gross amount and give you a higher net amount. As opposed to a company that maybe makes widgets, they have a lot of expense in buying those.
Right.
Sometimes that might be like a 50% debt expense ratio. But so from that perspective, we like to try and go to personal bank statements if we can.
Right.
Because that just takes all that out of the mix. We look at how much is coming in from whatever your primary occupation is, and we're going to do a 12-month average.
Nice.
Yeah, well, at least the investors will.
Certainly.
Yeah.
Okay.
The other cool thing is we can have that number very quickly. So if you bring me 12 months of bank statements, generally within 24 hours, I can have an underwriter look at those bank statements, ascertain the amount of income that we'll use for your loan, and by next day, we have a solid number in our system. We know exactly how much you can use.
Wow, that's key.
Yeah.
Super key.
We talked about jumbos a little bit, foreign nationals. I just wanted to kind of go over that. This is America, we're a melting pot. We have a lot of different people coming in and going out. We have foreign nationals sometimes who want to buy, they're not citizens, but want to buy a property here. We have people that have come here from other countries that have either, maybe they have a temporary work permit, maybe they have an ITIN number, maybe they have a temporary social security number, and there are a lot of different statuses of immigration. So each one we have to handle individually, but we do have programs in a lot of cases for a lot of those immigration statuses.
Nice.
So there's a couple, that we still can't do, but that makes sense, right? At a certain point, we have to have at least a minimal amount of documentation to do a loan for as not a citizen.
Right.
Yeah. And then we talked about the 1 year of tax returns, fix and flips. With the market being what it is, and some of the houses I've noticed, for example, here in Salt Lake City and Holiday, you've got a ton of houses over there that are not that are older and that need rehabilitation, and people still want to buy those, but how are they going to do the down payment, buy the house, do the rehabilitation? Are they going to get a home equity line? Where's that money going to come from? And we've got a whole rounded platform of programs to allow both. Almost every investor, whether it's USDA, VA, FHA, Fannie Mae, Freddie Mac, they all have their own variation of a rehabilitation program, so that as an agent, you can go to a house, see that it needs rehabilitation, and out of the starting gates, instead of worrying, I know you have so many times that the appraisal's not going to come in or it's going to have a problem on FHA. Instead of worrying about that, we sit down and talk about that in the very beginning.
Okay.
And we go, look, you say, Blake, this house is not going to pass. We got electrical problems, we got a roof that's falling apart, we got plumbing problems, we got what our investors would say health and safety issues.
Right.
So from that perspective, it's a non-starter unless we look at it on the overall as a rehabilitation, and we just go in simply and determine what needs to be rehabilitated. We get bids put together just like you would on a construction loan.
Right.
And we fund the loan and fund the improvements.
All based on future value.
Yes.
With improvements.
Yeah.
Nice.
Yeah, based on future value. So, I think that's going to become more and more prescient in this marketplace.
Yeah.
Using those.
No, certainly with the aging population, you got grandma that's not ever going to go in a home. She's going to stay there. Mm-hmm. But remodeling the house is not an option. Mm-hmm. And we have a lot of those properties in Salt Lake. So awesome.
Well, especially in the places I think where there's not much land left.
Sure.
Like Holiday, I use that as an example because I see most of the houses over there 1950s. Yeah. And so as a side note, we also have a fix and flip loan as well for the investors out there that want to buy, fix and flip. There's some people still doing that. It was much more prevalent, of course, during when the hot prices were there.
Last couple of years you couldn't miss jumping out of a boat. You're going to hit water.
But still there's a need for that. Yeah, no doubt, and we have programs for that.
That's awesome.
Yeah,
very good.
Do you have any other questions on
That's it.
Any
That's
of
it.
those?
This is good information. I mean, we're gonna follow up with some more stuff. But
Yeah.
I thought it was now's the time to really review some of this stuff, start to be aware, because as interest rates, obviously, the interest rates are what they are, and these programs are gonna what we see is the need to continue stimulating the market
Yes.
in some fashion, and so you're going to start seeing them loosen up. I mean, we saw the crash in '07. They tightened the belt up, and they tightened the belt up way too tight.
Yes, they did.
And so they overstepped this. So it
Yeah.
was aces, straights, and flushes, or you're no deal.
Yep.
And so they've swung to the other side, and I think we're going to find this happy medium. That there are programs out there. If somebody does want to buy today, the market is there. The nice thing is these people that have been forced to sit on the sidelines over the last couple of years because they didn't have the appraisal gap. You have talked about this many times. They're locked out of the market.
Yeah. Yeah.
And which was sad to see, because these guys have spent the last 3 or 4 or 5 years saving their money, repairing their credit, getting their down payment, getting their closing costs, and then overnight they were locked out and forced to look from the outside. So,
Yes.
I welcome those guys back in the market. Now's the right time.
Yeah.
We're seeing some interesting things with the market and sellers. Sellers are seeing they saw the illusions of grandeur of what's happened over the last couple of years, and now some of those people weren't a bit ready to sell then. Now they're ready to sell, and they kind of missed it almost. And so they're starting to see some of this correction. They're starting to feel it, where the house used to be only on the market for a weekend, multiple offers, and then they're done. Now it's a week. Now it's 2 weeks. Now these people are really starting to get nervous, biting their nails, going, "Oh crap, what's going on?" And then they hear what's in the media and what's going on, and I mean, it's real, but you kind of have to look at this. I think your analogy, you marry the house, you date the rate. Yeah. I really love that, because I don't know many people out there that are already my clients that when I sold them a house, they're still in the same mortgage so when we put them in it.
Exactly.
I mean, when interest rates start coming down, I know you work feverishly to take care of a lot of those people, and start to peel their house out of their hands right now with a sub 3% interest rate.
Yes.
So anyway,
but I do think, in fairness, kind of like a perfect storm right now, though. As you said, sellers are kind of maybe realizing that they missed a small opportunity, but I still think it's not as if there are no opportunities for them. They're still selling a house at market value.
Right.
So,
and anybody that's owned a house in the last 2 years has significant equity.
Correct.
Now.
Yeah.
And we're starting to see sellers contribute to closing costs now that we haven't seen, rate buy downs.
Yes.
Things to make their house more attractive. So now more than ever is the time to put the right professional team in place, because if you want the best deal on a house today, it's negotiated.
Yeah.
It's in the negotiation. Once you wait for these sellers to lower their price to a point where it's at the market, that's when all the people start coming in the woodwork. Now you're into multiple offer situations. We know how to win those because we won dozens of them over the last couple of years.
We have.
With some really special tools that we put together. Mm-hmm. But what happens when multiple offer situations come in? You're going to pay more money for the house.
Right.
You may still get the house,
yeah,
which is really what we're after, but you may have paid a little bit more than what you would have if we start negotiating now.
Right.
Okay. And now is the time, in my opinion, because these sellers are starting to feel the pain. Yeah. It's not gone in a week. It's not gone in 2 weeks. Some of them are gone in 2 months. And they're starting to incrementally lower their price. And if we can catch these people before they get to the bottom, where the threshold is to bring the masses in to start a multiple offer situation, is we can get this price if we start negotiating before they hit that threshold.
Well, you make a great point there, and I think it's important, from my perspective, to understand that you've got to have a great professional doing the negotiation for you. I've seen them out there, the cut rate companies, the market disruptors, which are having a very difficult time, I hear.
Yeah,
recently.
I empathize with those guys. I mean, I never like to see a CEO step down or be forced out or whatever the situation. I don't know, don't really care, but it's come in, and unfortunately that entity has a flawed business model, in my opinion, and they they shit on the industry for others, you know.
Well,
And,
important thing to remember is that it's professionals that understand the art of negotiation and the art of everything that goes into this, even right down to the personalities that exist between buyers and sellers, and the buyers' agents, or the sellers and their agents.
Oh, that's huge. I mean, and no time in my career have I noticed that as much as I have the last 2 years.
Yeah.
When, you know, normally we can contact an agent, send an offer, and be remembered.
Yeah.
You know, I only got one offer from Stu, you know.
Right.
But now they've got 10, 15 offers. How do they know any of us?
Yeah.
You know. And a lot of these agents I've done deals with in the past, they're like, oh, I remember. We did a deal before.
Yeah.
Oh, I remember Stewart. He was part of this, you know, Browse for a Cause or this charity or this event or whatever.
Right.
I've done this deal with him. I saw him here. Been around long enough. They start to, you know, opposed to the 15 other agents that may have been in the business, may not have been in the business very long. But those relationships that have bonded over the years, I can tell you made a huge difference in this past market. So
I've seen it happen over and over, and it's especially imperative in this market too. I would conjecture, based on the fact that right now there are a lot of concessions to be had.
Oh,
and
for sure.
You bring a master negotiator into that situation and start talking with sellers and buyers, and you have an inspection comes back, and you start to talk about the details of that, and then where can we find concessions inside here.
Yeah.
Once again, I think it's absolutely imperative to have a great professional that has this years of experience, expertise, and the knowledge of how to bring this together.
Oh yeah, how to overcome. I call it the turbulences. I have a list of 22 turbulences that could happen in a real estate transaction, and you know it's important to have that agent that's got the experience. It's like getting on an airline. You know, you start running into a little turbulence, the plane starts shaking, everybody's freaking out, but the calm voice comes on the microphone and says, "This is your captain speaking. We just ran into a little bit of turbulence that we actually expected. We're going to go up another 5,000 feet. We'll get into better air. Don't worry, I've been here before.
Yeah, as opposed
I know what to do. Opposed to, I mean, I had those when I was a new agent. I was like, we're all going down. Brace for impact. But you know, to have that calm pilot, and that's what I like to resonate with. And you know, I am the calm voice. I've been here before.
Yeah.
I haven't run into too many things that I haven't seen before or negotiated through before. And you know, real estate is a very emotional purchase. And you know, my uncle's a psychologist, and he likened it to this: that buying and selling real estate is the most emotionally draining experience you can have, short of divorce and the death of a loved one. So, when you go through real estate transactions, it's emotionally draining.
It is,
you know, because it's emotional. Me, my emotion's not out. I'm a trained professional. I've been here before. I know how to handle this. So when we do have emotions running, we know how to handle that. And so I love to be that captain, you know,
and you have been.
That comes with that calm voice saying, "Don't worry, everything's okay."
And you know, speaking of that, I feel the same way about our side of the transaction.
Certainly.
You know, we have things come up behind the scenes that a lot of times nobody knows about.
Right.
We've got appraisal issues. There's a list a mile long of things that can happen during the transaction where behind the scenes. And by the way, I'm in the cockpit and the flashing lights are going off. You know, I've got red lights going off, engine failure. I mean,
I get the calls all the time from clients like, "Hey, is everything good?" Like, well, hey, if I'm not hearing from Blake, that means everything's good. When I start hearing, that means we got to address something. We're dealing with turbulence, but they're dealing with nonstop turbulence behind the scenes, and like no news to me is good news.
Yeah.
You know, if I'm here, if I'm getting news from Blake's team, it's, you know, the appraisal came in low. I don't want to hear that. I don't want that call. You know? Like there's something going on. But you know, as Blake being part of my team, it's just, I know that I don't have to worry about that. I don't need to be in the cockpit. I can be back in first class. I can be back, you know, serving drinks to the clients. And, you know, I can go down the cart. I don't have to worry about what's going on in the cockpit on the mortgage side.
Well, I think it's important to note that there's so many people that over the years have been, I think, misled to try and see a mortgage as a commodity. Like a Ford truck or something. Like, well, I'm just going to go to the dealership that gives me the best deal on this red Ford truck.
Right.
nothing could be further from the reality of a successful transaction. It's important to understand all the things that go behind, all the things that we do. I've got a list. I mean, I'll read them off to you. Educating our buyers, spending quality time, coaching on strategies, options, and programs to meet their hopes and expectations. Title issues, handling title liens, notices, insurance, issuance, closing disclosures, prorations, balancing, and funding. Those are just a few of the things we do behind the scenes that nobody knows. Credit repair guidance, review, update, provide score improvement models, and to move scores up even during the process, so that maybe you get a better rate before we're done with the process. And by the way, we have an analyzer that can do a what if simulator that can tell the borrower where your scores are at now, 642. Where can we be that by the time this loan is finished? 683. Wow. And by the way, your interest rate is going to get a lot better with that echelon moving upwards. So we're happy to work with our clients as we go through the process. And a lot of people don't understand that.
Right.
Yeah, they just like, okay, I'm going to go in, I'm going to lock my interest rate in, which, speaking of interest rates, one of the things that bothers me so bad are the billboards on I-15. They make it appear as though there's one rate for everybody.
Right.
And I get so frustrated with that. And look, I know they're just trying to make a living, but I think it's a little disingenuous to, when people come to me and say, what is the rate?
Right.
Well, okay, what type of loan are we doing? FHA, VA, conventional, what jumbo? What type of score do you have? 620, 640, 700, 800? What type? Where is the loan located? What county is it in? Is it purchase? Is it refinance? Is it cash out versus no cash out? There are a lot of factors, so many factors that go into those. So once again, talking to a professional, understanding where that rate is coming from, and we can explain exactly where it comes from and give you options when it comes to your interest rate. And we want you to get the best rate, of course, but you also have to understand where that's coming from. And if your score is 620, then you'll know that you're not going to get the very best there is available, and of course not the one on the billboard.
Right. Yeah. No, I love that. There's so many moving pieces. In fact, that's why I don't keep track of it every day.
Yeah.
I got my own job.
Yeah.
You know, keep Blake in the cockpit of the mortgage industry, and I know that when I send somebody to Blake, I know they're in good hands. He's got an entire team to handle it. So. It's a huge peace of mind.
Yeah.
You know, I've got that in my mortgage guys. I've got that in my titles. I've got that in my contractors.
Yeah.
I've got it in my moving companies. I've got it in my junk removal companies, my handymans, my plumbers, my electricians. We got it all.
Yeah, I was going to say, like, this is not just a Blake rah-rah session or a Stu.
Yeah.
You know, the premise is you got to have a good team, the entirety of your team around you.
Right.
Yeah.
Right. And no, this is good, Blake. I appreciate you sitting down doing this with me.
There's a couple of things I want. We got a lot more.
All right.
While we're going here, I just want a couple more things before we're done, because I think this is like, man, I get excited about this because there are so many people I think out there right now that are really wondering what's going on in our market. What's going on with interest rates, and I'd like to do this a lot more with you, on a daily or weekly basis, to really dig into what's going on with interest rates today. What did the Fed just do? Why did a decision that they make impact our mortgage-backed securities market, and why is your interest rate going up or down?
Right.
Talk about what basis points are and what happens on a daily basis. But I wanted to kind of move back to some of the things that we do behind the scenes.
Yeah.
Because I think it's important for people to understand. Like, once again, it's not a one-size-fits-all. It's not a red Ford pickup truck.
It's shocking how that's the perceived.
It is. That's what's perceived.
The perception of it. You know, the billboard shows one interest rate.
Yeah.
You know, I can guarantee they got a lot more interest rates than that going on.
Hundreds.
I want to meet the guy that actually qualifies for the rate that's on the
billboard. I want to meet that guy too. Every time I go on the website and try and price it out,
capture him, bring him in
for study,
to do studies.
Yeah, so we'll find that. They're elusive, but apparently they're out there.
Well,
so we'll see. Appraisals, there's a lot of stuff that goes on behind the scene with appraisals. Ordering the appraisals, timing, accuracy review, if the submission and appraisal waivers, issues that go on behind the scenes if appraisal comes in low, or if there are items that need to be fixed. or remedied, health and safety issues, branch escrows for a roof that needs to be repaired. There are so many things that go on behind the scenes there. And once again, you need a seasoned, experienced captain at the helm looking at those things and making sure that all of those things come into place so that we close on time.
Right.
We're meeting our deadlines.
All right.
Employment and income, documenting pre-approvals in different programs, including program limitations. Assets, understanding, documenting, and disclosing before you shop, so understanding what your asset position is, and can we use some of that for income. Strategizing. This is important. So many people just sit down, and once again, you can go to a cut rate lender, some guy that's just barely out of college, that's not licensed the way we're licensed. Maybe they work for a bank or a credit union. They have their own set of licensing guidelines. They've never been in that cockpit when the red light starts going off.
Right.
And so even when it comes down to like strategizing on, okay, what if, for example, what if we have a loan where you don't qualify as a jumbo loan? And we're like, wow, but the loan amount is, let's just say we need to do an $850,000 loan amount.
Right.
And our jumbo pricing current on the early bird special we talked about only goes up to $715. What are we going to do? How do we? But we need the guidelines for the 715. We don't want to go to jumbo. We do a first-second combination.
Right.
Jumbo loan, 10% down, first-second combination, as long as the combined loan to values for the investor work. So that's there are so many strategies that can be used to, number one, get the deal done.
Right.
In the first place, we just want to find a way to get it done, and then secondarily, get it done the best way possible.
Right.
What is the best way for me to get you the lowest interest rate, the lowest fees possible? How do we create a strategy that does that for you?
Right.
So, and that's one of the many other things. Rate lock management. Again, like when are you going to lock? What's happening in our marketplace? What are the trends? Is it going up? Is it going down? Advice on how you're going to lock. Do you want to take advice from a youngster that just graduated from college?
Not when it comes to buying a house.
Not when it comes to buying a house. So, anyway, those are just a few of the things I wanted to kind
No,
of
I love it.
share.
That's so important, and these are the things that in my 15 years of working with you, Blake, I never have to worry about.
Yeah.
It's a peace of mind for me. I got my own stuff to worry about. I'm doing inspections. We're doing all contracting, you name it.
Mm-hmm.
But these are all the things that I mean, even in sitting down here, these are some of the things that I don't even know that is going on behind the scenes.
Yeah.
But I know that you and your team are masters at it, and you've seen the turbulence. I mean, it's one thing to get on a plane from here to New York. It's one thing to get there safely and in one piece, and not have all the luggage falling out of the rafters because you took the wrong route, right?
Yeah.
And so, we're going to do that safely, and this is awesome.
One last, I think, pressing piece of information for this marketplace right now. And maybe we put this out in different pieces or segments. I would like to, because I think sometimes I get excited. You do. We get into a long conversation, which I could talk for hours about this, but and it gets a little long. But I think this is a really important segment right here, and that is, what do we do? We talked about marrying the home and dating the rate, but what do you do in a case where the current dating pool interest rates
Right.
are not optimal? Right. So
Right.
one of the things that we have created, or one of the programs that we haven't created it, but we have leaned on it recently more than we have at any other time, is what's called a 2-1 buy down or 3-2-1 buy down.
Okay.
And
Right.
what that does is it allows a start rate at current market rate.
Right.
And then it allows you to gradually transition into that note rate. So just to give an example,
Right.
let's just say hypothetically that the base rate was 6.5.
Okay.
A 2-1 buy down would allow you to go down 2 full percentage points in your first year on that loan, so that you'd be paying, in essence, a 4.5% interest rate your first year,
Right.
a 5.5% rate your second year, and then the third year it goes back to the standard note rate.
Okay.
Now, not to confuse that with an adjustable rate mortgage. That's not
Right.
adjustable. Your rate was, hypothetically at 6.5, your rate was 6.5 the whole entire time.
Right.
The difference is that either the seller, the agent, or the lender, depending on the program, there are certain allowances of who can do that and who can't do that. Generally, the borrower cannot do that.
Okay.
So it has to be an outside third party. We love the seller to do that. And we
Right.
just had one where the seller did that. The seller contributed $11,000 to a 2-1 buy down, and the borrower had 2 full years of a lowered payment to work their way into that fixed rate.
Right.
Now, the other way cool thing about this is that if for some reason Fannie Mae is correct and rates do move to 4.5% next year,
Right.
we can go in and do a refinance for you, move it to 4.5%, and allow you to get the money back that was put into that escrow account to supplement your payment back to your bank account.
That's huge.
Huge.
That's huge.
Yeah. Now
No,
that takes some doing. It's either that or it goes on the back of the loan.
Right.
Back of the loan is easy. Getting the cash back is a little bit more difficult, but can be done.
Can be done.
Yeah.
No, that's awesome. And so that is the answer, and that is, we've called, the call has been put out to you guys. Help us.
Yeah.
The industry, the buyers, everybody's going, help me, help me. And so they come up with these programs. We find creative ways to do this. We may even start seeing some all-inclusive trust deeds, some wraps, some other stuff we'll get into on a later date. But, the time is right to purchase. The interest rates aren't ideal, but I believe they're just temporary.
Yeah.
And I think that, they will come down. They will adjust. I think and like I said, when I was growing up, I listened to my dad or else.
Yeah.
Right now, we listen to Fannie Mae or else.
Yeah. Yeah.
I could disagree with and say I'm not going to follow the laws of gravity, and then guess what? Splat.
Yeah.
Right. The laws of mortgage, we follow these guidelines, and this is I think is a huge answer to for these people to be able to buy. Hedging these interest rates are going to come down. They're just temporary.
Yeah.
Especially if we can get that money to not come out of their own pocket, it's going to come out of somebody else's. They're ahead of the game.
And I also think it's important. That being said, part of the strategizing that we do is to help each and every borrower. We hold their hand through the process. We educate them. We guide them. I know that's your mantra.
Yeah.
What is it?
We lead, guide, and protect.
Lead, guide, and protect. Feel the same way here, and to that extent, it's important that we help our clients understand the nature of the loan that they're getting into. So
Right.
when we're doing a 2-1 buy down, they got to know that interest rate is that interest rate,
Right.
and it might never change.
Right.
I mean, worst case scenario, that might be their rate for the rest of their lives, and make sure that even though they have that time to build up to it, make sure that they feel comfortable, number one. Number two, that they have the ability, after at that time, the income at the time, because we qualify them at the fully indexed rate. So
Okay.
we know that by the time that goes to the rate that it began with, we know that they're still going to qualify. It might be a little bit uncomfortable, but at least on paper, Fannie Mae, FHA, they're going to say, they qualify.
Nice.
And that's important, because what we don't ever want to do, of course, is put a borrower into a place where ever again, because that happened in the 08.
Oh, yeah.
We don't ever again want to, as an industry, we want to make sure that our clients understand the nature of their loan unequivocally.
Yeah. No.
And that they're prepared at every step of the road, whether it's a 2-1 buy down, whether it's a permanent buy down, we buy the rate down permanently, whether it's an adjustable rate mortgage. There's not very many of those right now, a few of them out there. Whatever it is, we want to make sure that they understand those terms so that they can make good decisions
Nice.
about now and for future.
Nice.
Yeah.
Awesome. Great session. I think this is good information. We're going to come to you with some more. We're going to break this out a little bit more detail, but more to come, both from Blake and myself. And thanks for coming, Blake.
You got it, man.